Hello everyone, this is Ted Bauman with your Bauman Daily video for Friday this week. Over my shoulder you can see a graph of what's been going on in the markets since the beginning of the year. It doesn't look too good. I want to talk about that, but first I want to put things in perspective, and to do that I want to show you a couple of charts, so let me call them up. Now this first chart shows you three different indices, the three major ones that everybody follows in the US. The top green one is the NASDAQ, the middle one is the S&P 500, and the bottom one is the Dow. As you can see, essentially we have lost all the gains that we had since the beginning of this year. So everything that those three indices had gained since the beginning of the year, we've lost them. The only one that was close to coming back up again above zero for the year was the NASDAQ. Now I'm recording this at midday on a Wednesday, so there's still some time to run, but fundamentally the year has been wiped out thanks to the last week's action. But then let's look at the bottom graph, the next graph. This is one that shows the last year. Now this last year, the NASDAQ was up almost 30%. Now it's up only 20%, but that's still 20%, and that's still pretty good. The S&P 500, a little different. It's up 12% now year on year, putting us back to about where we were in the middle of December last year. The Dow, which is the big industrials 30 stocks, a little worse off. It's only year on year up 5%, and it's putting us back to about where it was in November. Now, the next chart shows the S&P 500 over 10 years. And here's why I want to draw your attention. Look at the size of the dip in the far upper right corner. That's basically this last week. Again, I'm recording on Wednesday. So I don't know where it's going to be by the time you see this. But clearly, this is a very different animal compared to what we saw in the last quarter of 2018. That was a pretty nasty drop that we saw at that point. In fact, it's not even as bad as the one that we saw at the beginning of 2018. And in some ways, it's not as bad as the one that we saw again in the first quarter of 2019. So we've seen these kinds of big reactions before, right? We've seen these big dips. Now, this is obviously a different animal. We're looking at something that is caused by an external factor. Now let's talk about that. So essentially, the coronavirus is what some people would call a black swan. It's an external event. It's something that is not predictable by definition. It's something that comes and affects the stock market from outside. It's not driven by fundamental economic trends. It's not driven by what's happening inside of companies. It's driven by what's happening in global markets. And in this case, the transmission mechanism is very straightforward. Goods and services, at least physical goods and services, cannot travel if countries and cities are locked down, and that's why people are freaking out. That's why they're selling. But remember, there's more to it than that. And here I want to address a couple of issues that explain why these kinds of big movements happen in circumstances like these, which again will help you put it in perspective. The first thing is, a lot of people don't know this, but when there's a big move in the market like the ones that we saw on Monday and Tuesday this week, it's usually driven by big institutional traders. And in a sense, those big Wall Street traders have to sell when something like this happens, even though individual traders like you and I don't. Why is that? Well, big Wall Street traders really fight to attract clients and to keep those clients. And if there's a big downturn in the market, it's very difficult for them to turn around to their clients and say, well, we decided to hold on and ride it out. Instead, they tend to sell quickly in order to avoid those positions that are dropping, things like energy, things like transports and that sort of thing. But they do it quickly in order to avoid being able or having to show losses to their clients. Now, many times those positions are hedged. They use options, they use all kinds of tools and tricks to avoid taking the full loss on those positions. And because those positions are hedged, the total loss that those big Wall Street traders experience is a lot less than what an individual investor like you or I would experience if we sold at the same time. So the first lesson here is that the big movements in markets in situations like these are driven primarily by the activities of big traders who are hedged and who therefore don't suffer as badly as the actual statistics would suggest. The key thing is that you, as an individual, should not sell at times like these because, as we saw on Wednesday, the market tends to bounce back. And if you sell in a panic, you've already lost, and it's too late to buy back in. So essentially, lesson number one is let the big people take the losses. They've hedged them. They can afford them. Don't you do the same thing, because generally speaking, most of us individual investors, especially retirees, can't afford those kind of losses. Now, the second thing is, we've spoken a lot about computerized trading over the years. And computerized trading is essentially when big traders set up portfolios to trade on autopilot. And they look at a whole bunch of different factors. They look at the news, they look at what's happening to other trades, they watch each other, the different algorithms keep an eye on the market as a whole. And when certain thresholds are crossed, they all do the same thing at the same time, which is normally to sell. And of course, this is related to my first point, which is that they tend to be algorithms run by these big institutional traders who are selling but are hedged. So the second factor that explains these big rapid movements is the computerization of Wall Street and the US stock exchange. But again, this is not something that should drive you to sell, because it's basically a bunch of computers doing what computers do. They're fundamentally unintelligent. All they do is respond to the input data that they get using rules that have been built into their algorithms. Now, again, it's scary when that happens, but remember, it is not something that reflects the fundamentals of the companies in question. It's just the big money moving around. Now, what about the third thing? Well, the third issue is that a lot of big traders look at the background information that is going on in the market, in particular bids that have been placed using stop losses or limit orders and things like that. There's a group of big firms that are called market makers, which have the ability to look at the stock market as a whole, all the activity going on. They can see the volume of trades that are happening. They can see what people are bidding. They can see the prices at which people are setting limit orders and whatnot. And that gives them an ability to see movements in the market that us individuals cannot see. And when they see a big dip like this happening, they use that additional information that they have to conduct large trades that tend to move the market rapidly. Now remember, this all works in both directions. You get big downswings like we saw earlier in the week, then you get big upswings, like seems to be happening today on Wednesday. The lesson I want to essentially focus on from this presentation is that what we can see right now is a bad start to the year in terms of the having lost all of our gains for the year. But in perspective, if you go back and look at those graphs that I showed earlier, it's not really as bad as all of that. Now, what about the big picture? What about the coronavirus? Is this going to carry on? Are things going to get worse? Well, I don't know. I'm not an epidemiologist. I'm not a doctor. All I know is what I read and what I'm told when I look at what experts are saying. Now, the problem is that it's not the virus itself that is causing this economic decline and the decline in stock prices. It's the reaction to the virus. It's the closure of borders. It's the shutting down of cities. It's people not going to work. It's factories that are not open in places like China. That's what's scaring everybody. That's what's scaring stock markets. The virus itself, it's clearly a dangerous virus. It is killing people, but there's an possibility, and people are starting to discuss that it may simply become an endemic virus that is out there in the wild and remains there really beyond anyone's control, like the flu, like the common cold. Now, if that happens, if the medical authorities around the world decide that there's no point in trying to continue to contain it, they will lift all their sanctions and focus on treatment and focus on trying to immunize people if that's possible. If that happens, I would say that the economy will probably bounce back instantly because really, as I said, it's not the virus that is causing the problem, it's the measures being taken to try to contain it. So fundamentally what we have is a situation where the global health system is trying to contain this virus. It seems not to be working. It's spreading into different parts of the world. This week, the big fears were Italy and Iran and South Korea. It's now present in Latin America. African cases have emerged in Algeria. Just today, I heard the news. So the likelihood, in my opinion, and again, this is an uninformed non-medical opinion, is that we will probably end up with an acceptance that this is now an endemic global virus, and the attempts to try to stop its spread will disappear. Instead, the focus will be on trying to cure it, trying to immunize against it. And if that happens, there's no reason for the economy not to bounce back to where it was. Now, on that score, let's look at one final graph. This is a sector summary. Again, this is on Wednesday. It's a graph that shows the relative movements of different sectors in the S&P 500 during the course of the morning. As you can see, technology up strongly, basic materials up strongly, things like gold, for example, and other industrial commodities. Down big time energy as a result of the lack of demand for energy because of the shutting down of all these economies. Healthcare also up strongly. The reason I show this to you is because technology has been the thing that's driven the stock market over the last 10 years or so. The graphs I showed earlier, it was always the NASDAQ, which is the technological index, at the top. That continues to be the case. And I think the focus now is going to be on maintaining your investments in those rapid growth, high value stocks that we've seen over the last 10 years. So my overall message to you is whatever you do, don't sell now. That would be a terrible mistake. Hopefully we've all learned our lessons from the 2008 crisis, from the various dips that we saw in 2018 and 2019, that selling makes no sense. Stocks will bounce back if they are worth it. And all the stocks that I know I invest and I recommend here at Banyan Hill are worth it and continue to be so. So keep all this in mind. This may be the new normal, the coronavirus, but if it is, we can expect to see the market bounce back fairly quickly. And I predict that that's what's going to happen. Anyway, Ted Bauman signing off, and I'll see you again next week.